A couple of months ago, I made a video about how I made $177,000 buying, driving, and enjoying my Porsche 911. My good friend, Caleb Guilliams, made a reaction video to that video, basically saying he doesn't agree with how I was using the concept and how things shook out. And I believe that's an amazing thing because it's always good to get different perspectives on things like infinite banking and how it should be used. So he made a reaction video. Then, about a month ago, I flew out to his studio in Nashville, Tennessee. We sat down across the table from each other and really broke down the two videos. It's an amazing conversation where we go into really the macro of how everything works with infinite banking, but also the micro. We get really down into the weeds and get technical. And I love having conversations with Caleb because it always kind of shifts my mindset a little bit, shifts my way of thinking, and the same thing with him. So great conversation. You're gonna get a ton of value from it. Go ahead and check out the entire thing here, and any comments you have, anything that you'd like for me to answer, put them down in the comment section.
Devin, welcome to the Nashville studio, dude.
I was gonna say, you paused for a second. I was gonna be like, Caleb.
I'm so glad that you're here. You did a video recently on you made $177,000 buying and selling a car, and I reacted to it, and we both had the same conclusion. It was like, hey, let's get on and let's chop it up. What I love about you is you don't come super prepared, which I love, and here's why. This is an authentic conversation. This is like if we were to sit down, chopping it up, talking about the things that we agree and disagree. People are going to see this in real time. I don't have notes here. You don't have notes there. And we're just going to be talking about infinite banking, our philosophy around buying cars. I said jokingly, I'm like, my goal is to get you to not buy cars using your infinite banking policy. And you're like, well, I already bought two. So recently. So why don't you break down, number one, the new additions that you've purchased? And then what I would love to do is like zoom out, and I have the ability to write, so we can have like the whiteboard session. And I want us to do, as long as it needs to be, I want you to be able to best articulate your philosophy of infinite banking, buying cars, why you do it, why it's amazing. And then I won't necessarily disagree with that, but then I'll give my take and why I would never use infinite banking right now, currently, to buy a car. And we can kind of go back and forth. So yeah. Without further ado, dude, welcome.
Thank you for having me. It's funny you say I don't come prepared. It's been a theme in my life. I was best man at my cousin's wedding, and I didn't prepare a speech. I got up there, I was like, I wish I was more prepared for this, but I was just taking shots, and the liquid courage just came out. So it works. It works.
Yeah, okay. All right, well, we'll see. We'll see how it works. The people.
There's no liquid courage right now, I promise. I'm not drunk.
The YouTube comments are undefeated. Let's just put it that way. So they'll let us know what's working and what's not.
For sure.
All right, so as we zoom out, talk to me about infinite banking, buying cars. I have a whiteboard if you want to be able to draw, but I want to understand like how you would teach this to someone who's getting into infinite banking, and why using infinite banking to buy a car is a good idea.
For sure. So basically infinite banking, in my eyes, what it is, it's taking back the banking functions in your life. So one banking function is just where your money goes, right? Where it's deposited. Mm-hmm. So most people put their money in a bank. Yep. Bank of America, Chase, Wells Fargo, what have you. That's one function. So infinite banking is changing that, where it goes first. So instead of it going into a bank, it goes into a properly structured whole life policy.
Right.
That's one function. Second function is where
I'm going to draw while you talk. So
cool.
So function number one, you have a person putting money into a bank.
Yep, just where money flows.
Just so that's where it flows. And then person number two, this is the IBC person, is directing this money into a life policy that's properly structured.
Yep.
Yeah. Okay.
So same thing.
Yep.
Money's flowing somewhere. Second thing is savings. People save money in bank accounts.
Yep.
Right? It gives them on average 0.06% growth.
If you look out over time, 100%. Yeah.
Very, very little growth.
Yeah, low growth.
So inside of infinite banking, it's a place to save and store capital.
Yep.
That's giving you, with dividends, about 5 to 6% tax free.
Yeah.
So it's a better place for money to be saved.
When you say with dividends, are you looking at the internal rate of return, or are you just looking at the gross return?
Just the gross return.
Okay. Yeah. Could we agree that the actual return is less than 5 or
For
6?
sure.
Let's say maybe 3 to 4, and then we can actually talk later on how this number could be higher when you factor in tax equivalent and other things.
Right.
You could make the argument that life insurance as a value to someone is getting them 9 to 11% if you factor in everything.
Right.
But the actual growth rate is let's just say 4%. There's policies that we have that are probably closer to 5, but we'll just say 4% for this video.
Right.
Okay.
So
way
those
better
are-
return.
Those are
long-term.
two functions of banking.
Yep.
Where your money flows and where you save it. So
Okay.
you're taking back control of them, because inside of a bank, they control the money. They lend it out to make a spread on what they pay you and what they make. So if they pay you 1% and they make 5, they just keep the 4%. So they're controlling your money. Inside of a policy, you're controlling it because you have cash value.
Yep.
You can do whatever you want with that cash value,
Yep.
right? And that's a better place to save money. Inside of a bank, judgments, lawsuits, people can take the money.
Yep.
Inside of a policy in most states, there's creditor protections.
Mm.
So it's a safer place for it to go. So you're taking back those functions of banking. That's essentially what I view infinite banking as.
Yep.
The biggest function is what banks do with the money when
Yep.
they pay you a little bit and then
Yep.
they take it and make more. They make a spread.
Yes.
So infinite banking is making that spread. I tell people all the time is you can borrow from your policy. You do have to pay an interest rate if you
Yep.
borrow it.
Yep.
So you're borrowing the insurance company's money using yours as collateral.
Yep.
As long as you can take that money, that borrowed money, at a cost, let's say it's 5%, and make more,
Correct.
you're doing what the bank does.
Yeah, totally.
You're making the spread.
Yep.
With the cars, it's not the best use for
Hey,
policies.
okay. It's early on in the interview, Devin.
Yes.
Don't be folding too soon.
No, you made a reaction to mine, and I watched it, and I'm like, he's not wrong. Because
I was always wondering, because we had that text thread, but I'm like, you always wonder, like, when you send it, I'm like, hey, Devin's a cool guy. Everyone's gonna be better when we make videos, because I believe more conversation increases, like everyone wins when there's more conversations. But I couldn't make that video in some people because not everyone would be as easygoing as you.
Oh, but I get it, because like the whole thing with buying cars with policies, it's people can relate. Everyone drives cars. Most people. Some people like to walk and ride bikes, but most people drive cars, right? So it's more relatable, and it's kind of sexy to talk about buying a Porsche 911 and technically making money doing it. So it's kind of, for lack of better terms, it's a little clickbaity, right? It gets viewership, but then it gets people into a concept where they can learn better ways to do it. And I've told people all the time, it's like, buying cars is not the best use. The best use is really, in my opinion, to pay off debt. If you're paying 15% on a debt,
Guaranteed 15%.
you're getting that 15% back into your pocket. So it's essentially like, instead of losing it, you're earning it, so to speak. And you're getting it into a place that's protected from lawsuits and judgments.
Mm-hmm.
And then you're getting it into a place where you could use it to pay your premiums,
Right.
to make compound interest on. So buying cars is not the best use.
Yeah.
But if you're going to buy a car, I think it's the best way to buy a car.
Okay, we'll talk about that in a sec. So let's talk about flow and saving, right? So we'll talk about person A and then person B. Okay. And person A puts their money in a bank account. They have to pay income tax on the measly interest that they earn.
Right.
They have less creditor protection. They have more liquidity, we could say, early. So let's talk about the benefits of putting your money in a bank. This person has access to all their money. Long term, they're not earning great growth. They don't have great creditor protection. There's zero death benefit tied to it. There's no tax benefits. But people do this for convenience and liquidity. And FDIC insurance, regardless of what you think of it, it's valid, and so people see it as very, very safe for up until a point. Obviously, I wouldn't put millions and millions of dollars into a checking account kind of deal. But that's the pros of using a bank account. The problem is long term, saving your money long term in a bank account. There's massive opportunity cost. If you're only making less than 1% over a long period of time, I know that people watching this are like, I'm earning 3% in my or 4% in my account. Yes, but if we look out over 30 years, you weren't, and you probably won't. And if you do, all the things that we talk about here are just going to get a lot better on the life insurance side. Okay, so I'm trying to think, is there any other like benefits of using a bank to long-term storing capital? And convenience is a big one.
I don't think so. I think the reason why most people do that, it's human nature. We do what other people are doing. Like, perfect example of this. When I came here yesterday, I'm getting into the security line, and there's 2 lines open. I'm at a TSA pre-check. There's like 15 people in this line to put their stuff in through the security. There's no one in this one. I'm looking and everyone just keeps going to this line. I'm like, I'm just going to go to the one that's empty. Like, it's just human nature. If people are lined up in one thing, they think that's where they should be. So everyone's putting money in the bank. That's what people think they should do.
Right.
But most successful people do what other people aren't doing.
Right.
Right.
It's interesting because a lot of times people use social proof as like, most people aren't doing that, but it's like, do you want average most people results? No. All right. So then the person B, which is the infinite banking person, is putting their money into a life insurance policy. The cons to this is short term. You don't have as much money as you would have in the bank account. That's probably, would you say that out of all the people that you've worked with, that's probably the biggest thing that you have to overcome is the first couple of years, you don't have all the money that you've put in? I'm trying to think of other major cons. I guess the other major con is you have to someone's got to qualify for health. You know, if you're super afraid of needles or if you're not super healthy, this might be off the table, although there's creative ways to get around that. You don't get a tax deduction, but really the big thing in infinite banking is if someone does not see the long-term benefits of this and they just looking at the year 1 or year 2, they could say, well, why, like, the bank account gives me all of my money, whereas this takes a couple years to get all my money back.
I think that's the only 2 cons to infinite banking. Those are the only 2. You've got to be approved. It is life insurance. Not everyone is approved. But if you're not approved, you can get it on someone else's life. Like you were saying, there's ways around it. And 2, you just don't have access to dollar for dollar of your capital right away. Most of the policies we do, the efficiency point is year 3, where you put $1 in, you have access to that dollar. Overall efficiency, like year 6 to 7.
Yeah.
But that's
another way of saying break even. So your policies are breaking even anywhere from 6 to 7, meaning you have more money than what you've put in. And then you're saying around year 3, you're putting in $1 and your policy's increasing more than $1 in that year. Right. So overall, you're still quote unquote behind, but in that you could very much say going forward, the dollars that you put into this machine are returning more than $1.
Right. So that year is when it starts getting efficient. Right. So those are the only 2 cons, in my opinion. It's a long-term strategy, so you have to think long-term. And I don't know why more people don't do this, but like the average life expectancy is around 80. I'm 40. That's another 40 years. Like, it's a long time. And that's without taking into account I am very healthy. I drink a ton of water. I go to the gym 7 days a week. I get optimal sleep. I will probably live to be 100 at least. And then with modern technology, AI, who knows? I might live to be like 200-300 years old. Who knows? Right? So like, you need to start looking long term, not next year, 2 years, 3 years, even 5 years. But most people do not do that. They just look one step ahead of themselves.
Yeah. And the irony is, if something did happen to you and you died prematurely, this would be one of the best places. This would be the best strategy, period. You know, so it's like,
hands down.
If short term, you're worried about dying, this has got you covered. And then I agree, thinking long term. The con or the argument could be made that buy term and invest a difference, which we could talk about that later if we want, but we're going to stay focused on the infinite banking. So I would say the 2 cons are it takes a couple of years to get your money, and all of it. You still have access to lots of it in the first year. We all have clients that actually use their policy in year 1 to do certain things. So it's not that you don't have access to any of your money, but if you put in 100,000, you don't have access to all of that 100,000 immediately. But the benefits are it grows tax deferred. You can use it tax free through a policy loan. It will get passed on income tax free. You have creditor protection. It's the safest place to have your money other than U.S. Treasuries. It's very, very safe. These insurance companies are very well capitalized, heavily regulated, and aren't speculating. You have, different chronic illness riders. I'll draw this umbrella as a representation of like, you get to store your money in a place that actually protects you, not just from a death benefit, but if you understand the permanent death benefit, if something's guaranteed going to happen, which is called death, and I have essentially a option, I've bought a paper option that says they're going to pay on that. That gives me optionality throughout my life. There's things called chronic illness riders, critical illness riders, which essentially says I can tap into that death benefit prematurely if, God forbid, some bad things happen to me. Just gives me more options. And when it comes to planning, my belief is if you have discipline, more options are better than less options. If you don't have discipline, sometimes more options can be bad. We've probably both seen people that have done infinite banking that have actually done worse because they have control and then they do dumb stuff with their money. Yeah. So it's not, control is not a universal, you'll be better off. Control can be worse for people that don't know how to handle it. And so that's another, you could say that's a con. It's so hard for me to say that's a con because I want to give people the freedom and independence of being able to live their life, but that obviously doesn't work out.
I wouldn't say it's a con for that though, because that's going to happen regardless.
That's fair.
That's not tied to infinite banking, and you say, God forbid something happens to you, something's going to happen to you. It's guaranteed to happen. You're going to get really sick. You're going to pass away at some point.
You will die.
So I cannot for the life of me understand why more people don't do this. And I was in the same boat. Before I learned infinite banking, I was 34. And my wife that year, this was 2020, beginning of the year, she's like, we should get some life insurance. And I'm like, I'm 34, you're 26. Like, I don't need life insurance. I didn't think I needed it. I thought it was something you get when you're old, which is the dumbest way to think because then it's more expensive.
Yeah.
So I didn't think I needed it. We have insurance on our phones. We have insurance on our houses. We have insurance on our cars. There's no guarantee you're going to crash. There's no guarantee your house is going to light on fire. There's no guarantee if you're not me that you're going to drop this phone. I drop this thing all the time. But we have insurance on all those things that aren't guaranteed to have a loss. You and I and
aren't producing crazy amounts of income in the future.
Right.
Continue, sorry.
Like you and I are guaranteed to pass away. It is going to happen. Everyone watching this, you are going to pass away at some point. We just don't know when. Hopefully, it is way in the future, but it's going to happen. When it happens, if you store your money, if you flow your money, if you take back that function of where your money flows first into a policy, when that happens, your family is massively taken care of tax-free, income tax-free. The longer you live, the bigger that payout gets because of how we structure the policies. So it's one of those things I can't for the life of me understand why more people don't do it.
Well, I'm going to play devil's advocate with you because I think it's important for us to see both sides. So we talked about infinite banking. I'm going to change this to internal benefits just because that's how I speak. So internal benefits of insurance is saving and flowing and saving, and we talked about that. Let's talk about person C, which is the buy term and invest the difference person. This person is taking money, they're taking a portion of that and buying term, and then the rest of it they're investing.
Is this Dave Ramsey?
This could be Dave Ramsey. This could be, so they have their portfolio and, let's say they're earning anywhere from 6 to 9%. We'll just be generous. And in this scenario, though, if you only had the internal benefits, and nothing happened over here, we're not using the policy or anything, you can see where people say that insurance is, earning only 3 or 4% with all the tax benefits and stuff. Maybe this will be 6 to 8%, but that's with all the other benefits factored in. You still have a much smaller number. If all your money was in insurance, if I had to choose between A, B, and C, and this is, we couldn't use our policy. We couldn't do what infinite banking or anything, you can see where person C is attractive because they're even using terms like 12%.
Mm-hmm.
And then these things blow. I mean, you look at the difference between compounding at 4% for 30 years versus 12%.
Oh, it's night and day.
It's night and day. So their whole argument is at the age of 60, yeah, you don't have insurance anymore, but your portfolio is 3 times bigger.
Mm-hmm.
So if we sit with this, if all I had was internal benefits, I would probably choose person C if this is what I'm being shown. Yeah, there's benefits here. Yes, I get permanent life insurance. But if we're not talking about using our money, we're just talking about the internal benefits, person C is the most attractive because they have the term. So if they were to die in the next 30 years, they would have a death benefit that would still pay. Again, I'm trying to be as generous as possible because I'm not a proponent of people just putting all their money into life insurance, not doing anything with it, and saying this is going to be better than the stock market.
Right.
I think it could be an amazing bond alternative in a portfolio. Or if you were talking to an entrepreneur, I think it could be a great place to save and store your money to be able to use. But I'm not thinking life insurance is an investment.
Right.
And so if you're trying to replace it as an investment, I think over the next 30, 40 years, you will be disappointed.
Right. I agree.
Push back on though. Like if you could not use your money, you could not borrow against your capital, would you put all your money into life insurance? Or would you only use this as a bond alternative? You get what I mean when I say bond alternative? Like if you couldn't lend against it and do infinite banking, how much money do you think you would put into life insurance versus like
I honestly wouldn't put that much. I wouldn't. Like I put a lot right now, almost $1 million a year into policies. So
because you can utilize that capital.
Exactly. Because I can use it and I know that borrowing money is not taxable. So I could use it for income, which I plan to do when I get older. Take a policy loan, use it as tax-free income, never pay it back, and then when I pass away, the death benefit pays off those policy loans. That's a strategy. I can use it to go do investments. I'm not taxed on the loan coming into my bank account, so that's tax-free money. I take it to go do an investment, make a return, that spread on money I was telling you guys about, all while it's still compounding in the policy. If I couldn't do that, yeah, I would probably get some term and invest the difference for sure.
So I think it's important for us to say that because I think a lot of times people will paint what we do in bad light, and it's like, no, we're actually we get the talking points, but what we're not saying is just put your money and have it compound for 40 years and do nothing with it. So now let's talk about the external benefits. Okay, so external benefits is what you do outside of the policy. So person A is putting their money in a bank account and they're withdrawing that money, so they're not having to pay any interest. So it's costing them zero. We'll say control cost. It's costing them zero. We know opportunity cost. If they were earning any interest, they're not making much, but it doesn't really matter a ton because they're not making a ton to begin with, which is another fallacy because it's, if you're saying, well, I'm only making so and so much, so it doesn't cost me much. Great, but you have to compare to what you could be doing.
Right.
We have to really actually compare to long-term compounding of what you could be getting in a life insurance policy if we're factoring it in here. So their control cost is technically zero, but the opportunity cost is whatever they could be making long-term in life insurance. So you could say that the opportunity cost is more than 4%, especially when you factor in taxes.
Right.
Okay, so and then they can buy whatever they want. You can buy assets and liabilities. We'll just pretend that that's liabilities. My lovely spelling. Okay, so, and then obviously there's many people we know that have become very wealthy. They save money and they buy a bunch of assets, buy real estate, buy businesses, invest crypto. Are you a fan of crypto?
I'm in some. I've got some coins.
Did you lose big over on Friday?
On paper.
Okay.
Yeah,
okay.
but I didn't sell.
Okay. No, and we're recording this after the massive dip that happened, and it was just very interesting to see. But it's just interesting to see people's reactions to that. Real estate, business, crypto. You know, I know you do lending. There's a lot of different ways to make money. Would you consider a car an asset or in the liability? Because I know as a business owner, you could make the argument that driving a nice car attracts business to you, and we can talk about that. But like, where would you put, if we're real talk, like, would you put a car in the liability section or the asset section?
99.9% of the time, it's in liabilities.
Okay, so
it
we'll
could
just
be
say
an asset.
99% in liabilities. So it's car. Would you say that your purchase is an asset because of you using it for business and all?
Gosh, it depends. Like, because I don't really use cars directly for business. So that's why I say 99% of the time it's a liability. Okay. An asset's just something that puts money in your pocket, right? So the car isn't directly putting money in my pocket, so it's a liability. If I took it and I rented it out and I'm getting
but you're not renting out your
right.
The last thing you're gonna do is say, "Hey, stranger, here's the keys to my beautiful car."
Not happening.
Okay.
Yeah.
Okay. So if we're just looking at person A, they're putting money in a bank account. Obviously, they're withdrawing that money, buying assets, and over time, stacking assets is where they're going to win. And, you know, cars, vacations, what are other things that are like people talk about in infinite banking that may or may not make them wealthy? Cars, vacations,
watches.
I'll even say second homes.
Yeah.
Second homes. All things that are emotionally appealing that draw us in and aren't actually, I mean, you could even say cars could help you show up more powerfully. Vacations could be spending time with the people that you love the most. Watches could help you show up powerfully, look great. I know you're flashing.
I like watches, yeah.
And then second homes, again, experiences. What's the value of experiences? That's not the point here. It's just the definition of assets versus liability. Assets appreciate, put cash flow in your pocket. Liabilities potentially stay the same, depreciate, and take money out of your pocket. Okay, so person A, they're obviously the internal benefits is almost zero when they're using their money. So they get almost no benefits internally. They obviously have their money. Hopefully they buy assets, not liabilities, and that's how they grow wealthy. We tracking?
Yep.
Okay. Now, person B, the difference between person B and A is they still get all the benefits of insurance. So all the things that we listed, all the benefits in insurance, credit protection, gross tax deferred, like all these things get the death benefit. So if they use money, their control cost is going to be higher. What was in your video? What was your last policy loan cost?
It was 5%.
Okay, so we'll say 5%. 5% is now the control cost. Now people freak out. I'm having to, I need to borrow to use my own money. Well, technically, if you don't want to do that, you can just withdraw your money.
Right.
Reason you wouldn't want to do that is you give up a lot of flexibilities of being able to put that money back in the policy and all. So we borrow against the policy. So it's not technically our money. We're getting all the benefits of insurance. And again, this only makes sense is if you value your insurance policy greater than 3 or 4%. And that's where it's really important to me to say, like, with all the benefits that we're getting, I value my life insurance policy around 9 to 12% to my portfolio. I'm not saying that it's getting 9 to 12%, ladies and gentlemen, when it comes to cash flow. It's just life insurance as a portion of, as a foundation of my financial life is getting me a lot more benefits, because if you factor in taxes, when you factor in credit protection, when you factor in the death benefit, when you factor in optionality, there's lots of other benefits that when you factor in, those benefits aren't free, but they don't necessarily show up in an internal rate of return calculation. You have thoughts or questions on that? Because that's a really important.
Because I've never heard that before.
So
yeah.
So a life insurance policy, let's just say it earns 4% internal rate of return. So that means cash on cash over 30 years, it's a 4% rate of return. Okay, so that means when you factor in just the cash value, it's 4%. Now, life insurance gives you a lot more benefits than just the growth rate of the cash value. You have a death benefit that's permanent, that's growing. What's the value of that? So how do we factor that in? Well, you look at what you would have to pay in term, you factor that in, and when you add the death benefit, now this 4% is now, turning into 5.2%. I'm just making this up, but because if you buy term and invest the difference, you would have to take some money away, which indirectly would make this lower. Does that make sense?
Got it.
And now it's like, okay, how do you value, taxes? In a savings account, you have to pay income tax on this. So let's just assume a 30% tax rate on here. Now we're taking this 4%, we're factoring the death benefit, which is making this an equivalent of 5.2%. Now, if you add taxes, now this is a 7.1%. And again, I'm just riffing. This is not direct numbers. So don't fact check me in the comments. And if you want, just let me know what this would actually be. Okay. And now it's like, okay, how do you value, like how valuable is guarantees to you? How valuable is creditor protection to you? How valuable is the ability to leverage against it? How valuable is all of these benefits and getting it liquid? How valuable are all these other benefits? Now you can start factoring in some type of like value fee. And the value fee isn't just another way of saying, what would you pay anything? Like, do you value any of these? And if so, how much would you be willing to pay for those values? And so let's just say like you value it at, like you would be willing to pay a 1.5% fee for all the other benefits you get with like insurance that aren't necessarily showing up in an IRR calculation. Now you're seeing that that 4% internal rate of return shows up like a 9%.
Got it.
Because you have to earn 9% in a different account that gives you liquidity
in order to afford all those things.
Just to be able to justify. So when people say life insurance only pays X, they're just looking at one benefit in a multidimensional aspect.
That makes sense.
Okay. So that's I try to be technical because we're not, in a lot of cases, we're not arbitraging cash on cash. In a lot of cases, your life insurance policy is not going to earn more internally than what you're paying externally. But if you factor in all the other benefits that you're getting, I would rather have insurance and get the benefits of insurance and pay the control cost.
Mm-hmm. That makes sense.
Okay. So that's what I'm saying over here. So you're paying, let's say 5%. Now, also playing devil's advocate. If life insurance policy had no other benefits, no death benefit, it only paid you 4%, I would not borrow at 5 to earn 4.
Right.
I would withdraw that money and pay it back.
Right.
So but the reason we're doing that is we're getting all the benefits, and if you withdraw that money, you can't put it back. So for those two reasons, that's why you take the loan. But if taking a loan is like such a trigger and it's like you don't want to do that, you don't have to do it.
I'd play devil's advocate on that though.
Please, yeah, please.
If it's earning, let's say 4,
yes,
compounding, and you borrow at 5, simple interest, because that's what it is. It's a simple interest loan.
Yep.
Technically, you could still come out ahead as if you're doing the concept correctly. So most people, what they do is they'll borrow from a policy and they don't have a plan to repay it.
Yeah, but you're not including apples to apples, because the repayment is, and this is where we're gonna clash when it comes to the car example, is because you're not wrong. If you're taking compound interest at 4%, we'll just say $100,000 compounding over time. You have that 100,000 and it's continuing to grow over time.
Right.
And now let's say you take a 4% loan, $100,000 loan, and it gets lower over time. Why? Because you're adding new money. Your new money is paying down this. And so the thing is, it's actually identical over time if you factor in the opportunity cost of that new money. Because over here, I'm including on a higher number. And so it's not apples to apples because I'm adding new money to lower this principal down.
Yes, but it's new money that you would have had to add somewhere. So if for a car example, if you're going to buy a car, you've got to have new money to go get that car somewhere. So
Right.
if you get it from a bank, get a bank loan,
Yep.
and the payments are $1,000 a month.
Yep.
That's new money you have to pay down that loan. So that $1,000 is gone forever. If it's within a policy, you pay $1,000 down, it's available right again
Right.
in your policy.
And we'll address that as well, because what my argument would be is if you never took a loan against your policy to begin with, you would have all that liquidity immediately as well. But do you agree that like this is actually a wash if you include new money? Because I hear what you're saying with new money, and we can factor that in, but it's the reason I totally understand where you're coming from, because if you look at over time, this number will be higher than the interest paid. So paid interest, let's just make this up. Paid interest will be $5,000 and earned interest will be, let's say, 15 over a time. And so we would say, I would rather pay $5,000 to make 15. That's what we say, right?
Right.
What we're not factoring in though is over here we're including new money. So it's actually not an apples to apples comparison. And if you had an apples to apples comparison on the opportunity cost of what this new money could have earned at 4%, you would actually get identical. You gotta trust me on this. This is math. It's not like and again, we can do we can get out calculators if we need, because this is an important factor to understand.
What if that new money came from an investment off that $100,000? So that $100,000, you took a policy loan at 5%. It's earning you 4%, so you're not making a positive arbitrage.
Right.
But you take that $100,000 and it makes you 15%, which would be $1,000 a month.
Yeah. So let's do this. So you have $100K over here. 100K over here. Let's say it's earning 4%. Okay. So this is the internal benefits. Internal benefits. Okay. Now what am I doing?
So you've got.
So my control cost is 5%.
5%.
So my control cost, 5%. 5%. So which is how much on 100,000?
5,000.
5,000K. 5,000.
If you pay nothing back.
Okay. Yep. So let's just do 1 year to make it simple. So 5,000. I'm earning, let's say 4,000 over here. Okay. And then what's my asset that I'm buying?
Let's say 15%.
15%. And so I am earning
$1,250 or $1,200.
Let's do an annual.
$15,000.
15,000,
which is $1,250, I think.
Okay. So in this example, would you, the audience, pay $5,000 to earn $15,000? It seems to check out, right? I'm paying $5,000. I'm earning 15, so I'm netting $10,000 on that activity, and my policy is growing. Now, what I would say is I don't like to factor in this growing because this is going to grow regardless.
Right.
So it's like you could lose money over here, and let's say it's 4,000. It's 4,000. So you lost over here negative 1,000, but you could say, well, I'm actually ahead 3,000 because of my policy. Well, you would have been ahead of 4,000 if you didn't do the dumb investment. So that's kind of so that's why I split up internal versus external. Yeah. But no, like all day long, if you can buy assets that produce cash flow, I mean, you're cooking with gas. And that's where if we go back to person A, B, and C, person B will beat buy term and invested difference if they're utilizing that capital well. If they're not utilizing that capital well, it would be my opinion that the buy term and invested difference would actually be ahead because by default, they're investing when this person's just saving.
Right.
Okay. Any other follow? I mean, I want this to be as raw and authentic as possible. So what other questions do you have? Because I want to address the car example, but I want to make sure that this makes sense. Because what we can't say, or we can say whatever we want because it's a free country, but 4%, if I'm earning 4% and I'm paying 5%, we have to understand in this scenario, we're not ahead. Yes, the life insurance is getting you more benefits, but in this scenario, compounding at 4% versus paying back at 5%, if you factor in opportunity cost, you're paying more in that scenario.
Unless you can take that and earn more than the 5.
Yes.
Right. Okay.
Yes. And that's why that's where in my head I have internal benefits, because you're getting the internal benefits regardless. I know somebody who they lost everything on their activities, and they were so grateful that they had life insurance, because as they were working back, they got all the benefits of the internal compounding. They're super grateful for that, but they acknowledge that they were way worse off because they took the L in losing that money. They were grateful that they had life insurance versus saving money. So they were like, over time, they were actually better off using the life insurance, but it was still that external benefit that was the make or break.
Yeah.
Okay. So now we're going to get to, so person B, control costs at 5%. They can go and buy assets, or they can go and buy cars. Okay. So let's paint a rosy scenario. Your average investment, you're not giving investment advice, but what's your buy box when it comes to like what you're looking for from a return in investments?
I want at least 10%.
Okay, at least 10%. So we're gonna say 10%. Okay, we're gonna say 10%. So if you're paying 5%. You go to our and asset vault, which will be in the links below, and you go to our calculators. You'll have our external return calculator, which here, if you're getting 10% and your control cost is 5%, boom, it's 100% rate of return on your money, Devin. That's amazing.
Right.
So your policy is earning whatever it's earning. It's getting you all the benefits. You're paying 5% to the insurance company, and your investment is 10%. I also want to acknowledge that there's risk in everything. So you're not 100% in all your investments. So you're factoring in that, so that's another, when people watch us talking about investments, it's not as easy as just like, I want to make 10%. Like there's risk associated to that, but that's like 100% on your money is great as an external activity.
Yeah.
Okay.
And just so people understand, again, this is just external. This is not including what's going on in the policy. Once you add that into it, it makes it just a cheat code. And
my argument would be, you're totally right. You're totally right. It's internal is getting you. Can we agree that your internal benefits is getting you the benefits regardless of what decision you make?
Right.
Okay. So we'll just say Devin, because remember, I'm here to try to convince you not to use your policy for cars. That's my agenda. And we'll see. I'm up against it could be a hard battle. Okay. So Devin number 1 versus so Devin non-car Devin. We'll call you non-car Devin. You're gonna drive a Kia.
I don't know if that man exists.
Non-car Devin. No, we're just gonna get you a car. I think we're gonna do it in a better way. Okay, so you use your policy, and you buy 10% investments. Okay, buy 10% investments, and I'm just gonna say, and you use the bank loans for cars. What's a typical bank loan right now? Let's ask ChatGPT.
7-8% for a car.
Okay, 7%. Okay, I think you see where I'm going with this.
I mean, yeah, you're making 10 instead of paying.
Okay, so my thing is, okay, number 1, I'm looking at this. You remember early on when you said one of the best rates of return you can make is paying off high interest rate debt? So if I had money, let's say I had $1 million of cash value in my policy. I'm gonna do this. I'm sorry guys for this is like, again. Okay, so this is Devin. You have $1 million of cash value available. You might even
have you been looking at my policies?
No, is this pretty accurate?
That's pretty close.
Okay, you have $1 million of cash value. We agree that you get all kinds of benefits to this. Incredible. You're setting yourself up for massive success with your family. $1 million of cash value available. Okay, over here, you could buy an asset, let's say 10%. I know you, and I know the 10% is actually more on the conservative end.
Right.
But 10% is kind of like, it's hard to get you out of bed less than 10%. Okay, or you could do a car loan at 7%. Okay, this is like, okay, so there's 3 things that we can do with this money. We can keep it liquid. Keep it liquid. This is super valuable because if all your money was tied up, you have less freedom, in my opinion.
Right.
More capital is more freedom, in my opinion. So more freedom. So liquidity for me is really important. That's why I wouldn't tie up my money to make 1% difference, because it just was like, why would I tie up my money to take on potentially risk to only make a little bit?
Right.
It's like I value liquidity more. Everyone values liquidity a little bit different. If you're an entrepreneur, you probably value it more than maybe someone who's not an entrepreneur, because you see opportunities everywhere.
Mm-hmm.
So you could keep it liquid. You could buy assets. You could buy a car. Okay. Now, how easy is it to get a business loan to get a 10% investment?
Pretty easy.
Is it?
Yeah. I mean, it depends on the size of the loan.
And where, and okay, let's just say where, when you say 10%, what are we talking about here? I'm thinking of like an alternative investment, but are you talking like, when you're earning 10% in an asset, what type of asset is this?
I'm thinking real estate, private lending.
Okay. Let's talk about private lending. Private lending, what's your average rate of return on private lending?
Like 13.5, 14.
Okay. Do you lend other people's money to do private lending, or do you use your own money?
I technically use other people's. I use the policy, which is the insurance company's
yes.
money.
Okay. So, but you don't necessarily go to a bank.
Right.
What I'm trying to say is there's certain, like real estate is easy to get loans,
right,
but there's other investments in business. Like if I want to invest in someone's business, could I get an SBA loan? Sure. But it's a lot of red tape, a lot of work, and
right,
it's a lot of hoops to jump through. Whereas getting a car loan and or a home loan, and you know a thing or two about this, because your wife is in this business, is a lot easier because it's standardized.
Mm-hmm.
So there's 2 things going here. Is number one, the car loan is cheaper than what I could invest, but it also is a lot easier to get a car loan, which keeps liquidity. So 2 things happen when I get a car loan. I have more liquidity for opportunities, and I potentially have the ability to buy more assets.
Mm-hmm.
That's for me why I would get a car loan versus using my policy, because if I use my policy, you're totally correct. You're internally growing your car. Like there's nothing incorrect about what you're talking about. Although I would say if your control cost is at 5%, and you could say that you're making a difference between a 2% investment. Like that's how I look at this: is if your control cost is 5% and you're saving you would be paying 7%. You are actually, that is a benefit. But I look at it as, would I invest in a 7% investment? And the answer would be no. I wouldn't tie up my money to invest in a 7%. My buy box is more like 15. Just because as an entrepreneur, I don't want to tie up money for less than 15. So if I can get a home loan or a car loan, I'm going to do that. Still, if I want to be an honest banker, and let's say I want to charge myself 10%, I can still send that 3% back to my policy. Just because it's going to a bank doesn't mean that I can't save more money in my policy, because that's really the power of infinite banking, is flowing as much money to you as possible. I just when I look at buying cars, I see it as something that allows people to like be like, oh, this is amazing. I get to drive my car and have money growing over here, but my money's already growing over here, and I value liquidity, and I want to be able to buy things that aren't as easy to get loans. And if it's standardized to get a loan for cars and homes, I'm going to take that. And oh, by the way, if I'm ever underwater or if I ever don't want the loan, I can always pay it off. So I'm staying more in control by having liquidity and potentially buying assets than taking some of my liquidity, tying them up into cars. So push back, because I don't know if I totally like am articulating this well, but that's my view on why infinite banking and cars, like that's my opinion. Now, if car loans were at 19%, we have a whole different conversation. It's like, yeah, so this may not last well, because depending on where interest rates go, that's kind of my philosophy when it comes to external returns. And you can say, yeah, well, my internal returns and all that, but that's going to happen regardless of if you do nothing, you're still going to get the internal returns. And so if that's the case, that goes out the table when we're talking about external benefits. Yeah, internal benefits are going to happen regardless. Like, you could go set your cash on fire and still have an internal return over here. So if that's as a result, I'm like, well, yes, buying the cars, you get that internal return, but putting your money in a CD arguably potentially could be better off. And I think you and I would both say don't take a policy loan and put your money in a CD.
Yeah. Where I would push back is,
please do.
I don't even know how to use this.
Yeah, you're like, I'm 40 years old, dude.
Yeah, I'm an old millennial. No, but basically, like, where I would push back is if you go do this asset, so you take this to go buy this asset that's going to earn 10%, it could lose money, right?
Yeah, there's risks.
Like investing can lose money, 100%. Hopefully it never does.
No, but it will.
But
that's why 15% is my minimum, because why would I take risk
for less than that?
Yeah.
So this could lose. The way I look at buying cars, again, it's not the best use for a policy, and the word need a car is something that I threw out earlier, but it's like, I like cars. You feel good. It helps me show up better in my life having a nice car. I've just always liked cars since a young age. So if I'm going to go get a car, if I get this car loan at 7%, I'm losing 7% all day long, because I'm paying that towards an outside institution. If I buy it from my policy, I'm no longer losing that. I'm immediately getting it back into my policy. I can't lose when I buy the car or from a policy, because what I was going to pay, I'm going to get it back. The only way I could lose it is if I didn't have the discipline to pay back what I would have paid the bank. That's the only way I could lose in that situation. With the asset, I could lose the entire amount. I cannot lose with the car because I have the discipline to pay myself back what I would have paid the bank. So that's the only pushback I'd really get. Again, it's not the best use for a policy.
Yeah.
But if I'm going to go buy a car, if it's going to happen, I cannot lose as long as I pay myself back what I would have paid the bank. Yeah. So that'd be my only rationale behind that.
Yeah, I'm with you, and I want to better understand this. So this is the power of, so this is okay. So this is you, and you're making money, and you are saving.
That's me pre-gym.
Yeah, saving. You're saving, and then you're spending. Okay. And the idea of infinite banking, it goes back to you want the volume. You want to save as much as possible. And I know that you're saving a ton. A lot of our clients are saving a ton of money. We'll just say for right now, you're saving 30% of your income and spending 70%. This may or may not be accurate. I bet you're probably saving more, but we'll just say saving 30%. Okay. So one of the goals in what we're trying to do is we're trying to help increase people saving as much money as possible. Okay. So you're saving money, you're spending, this is equals your lifestyle. It equals your lifestyle. Okay, so now you're buying a car. You want to buy a car over here, and you're saying you're gonna take some of your savings, purchase this car, and then you're right over here going to be paying yourself back. Just to be clear, guys, we're obviously there's an insurance company here. I'm not saying you're paying yourself back, but just from a simplicity standpoint, we're just showing the flow of money. And so, again, this is an equivalent of earning like a 7% kind of deal. And so you're saying like, hey, if I invest in other things, there's risk tied to that, and so I know that I'm good for paying myself back. And so that's what you do. And whereas I would say, because you're already paying this out of lifestyle, so the money that you're coming up with is already money that you have set aside for lifestyle.
Right.
All I would do is I would say, this bank over here, I'm going to pay them 7%. So yes, the bank is actually earning interest. The bank is earning interest. I'm going to hold on to my money and invest or hold. If I hold my money, it's technically costing me a negative 2% because I'm paying 7%, whereas it would only cost me 5%. So it is costing me 2% to hold on to liquidity. So that's, some people, like for me, that would be worth it. For me, it would be worth, I will pay 2% just to have access to money. Some people wouldn't. Or do you invest? Anything that you could invest, the opportunity cost of what you could invest is a true cost here. And so that could be a 4% difference. It could be a 10%. It just depends. That's how all I'm saying is, yes, you're paying the bank, but it's, the opportunity cost is you either have money that you hold on to, or you could invest that into a different opportunity. And you could say that you could invest in an opportunity that provides more money, which allows more savings. So you could say, right, you're saying like this extra 2% could go here. I could make the argument that you could invest in opportunities that create more cash flow that allow you to save on way more than that extra 2%.
Agreed.
So that's the whole.
That just has a bunch of risk.
That has risk.
The higher that is, the higher the risk of that is.
Can I play devil's advocate though? You have risk as well, because your ability to pay that is, right now it's really high, but what if something happens to you? Now your savings and investing is also tied up with you're the one creditor, essentially. So I know it's like, you're like, hey, everything's going well, but what if business takes a huge dump, dude? Now your savings are tied up in something that you may or may not be able to pay. I know that's a weird route to go down, but it feels guaranteed, but as an entrepreneur, we know nothing is guaranteed. And so that would be my other pushback is lending to ourselves is not always as guaranteed as we think it is. Obviously, it's not like we're going to default, we're going to figure it out, but it's like we're now tying up everything into one person. Now if you get disabled or if business goes down and all, now it's all predicated. Now your ability to pay your premiums and your ability to pay back the loan is on the shoulders of one buff man. That's the other thing, is like, from a risk management standpoint, diversification looks, and not just diversifying with external risk, but also looking with internal risk as well.
Like I said, when you made your response video, I agreed with so much of it. Okay. At the same time, it's like, it all depends on the person, right? Like if I had, for instance, we just bought 2 new vehicles.
Yes. Talk to me about those.
So wifey has been driving the same vehicle for 7 years. Mm-hmm. We got her a brand new 2019 Camry back in 2018.
Cool.
She loved that car, but her mom and stepdad share a car, and it's always a big thing that they share a car. Mm-hmm. So we're just like, let's give her your car. She loves her car. So then we got to get you a new car then. So we get her a new Audi, and then I wanted a 4Runner. So I got a 4Runner. Nice. Reason for that is because we bonk our daughter's head every time we get her in the car because we have cars. So something a little higher. So I bought those 2. It came out to total for both is like 100 and, I can tell you right now, it's 77 for hers, 66 for mine. So whatever that is, 153?
153K for 2 cars.
right? Am I doing that right?
I don't know. 143.
143. All right.
Okay. 143.
So 143,000 for those two cars. So if I had cash value of 200, 250, 300, even 500 grand, I would not do that.
Because of all the points.
Because of everything
Okay.
you said. Absolutely. It wouldn't make sense to tie up that much of my capital
Yep.
for something where I'm going to get back a little bit of a return. In my opinion, it's a guaranteed thing because I'm not going to miss payments to myself.
Yep.
And if in fact things hit the fan, I could miss payments to myself and the cars aren't getting repoed.
Right.
Okay. If I had a bank loan and I was missing payments, they're getting repoed.
But you also would have $143,000 of extra cash value over here that you could pay. That's the pushback to that is you're.
Oh, so you're saying if I didn't use that
Yeah.
and then I needed to pay them off,
Yeah.
I could. Okay.
Yes. Yeah.
I get that. Okay. So this is about what I have now after buying this.
Okay.
Okay. So I had plenty.
So you're like, I'm rich.
I looked at it like I can go buy these two and I still have a good amount of liquidity.
Yes.
So if an opportunity comes up, I can pounce on it still. If I didn't have that much, I would not do
That's
that.
fair.
It just would not make sense. So I try to explain to my clients, it's like everyone's different. Yes, I buy these things, but it's because I can, and it's not a bad decision because of how much liquidity I have. Years prior wasn't the case. Like
Mhm.
you actually helped me change that mindset a little bit when we did our interview in where was it? We were on the
We're in
Lafayette
Bahamas.
trip.
Yeah.
Yeah. And we were talking about how when I get money in my policy, I deploy it immediately. And I think at that time I had maybe 200 grand liquid. And you were like, well, dude, what if you can't fund all those premiums you have? So I started thinking like, well, what if he's right? So then I started really like building up the liquidity. And now all I do is everything flows towards policies, paying down the policy loans. And then when premiums are due, I just pay them from the policies.
Mm.
So I'm just building up the
So
liquidity.
you're using your life insurance loans to pay the premium, and then all your money is just going to premium payments.
Premium loan repayments.
Yeah, so you're almost doing like velocity banking with your life insurance.
Exactly.
Okay.
Yep. So any extra money I have in my bank account, it goes towards paying down policy loans. And then once a premium's due, instead of letting it just sit in the bank
You know
account.
what your minimum premium is? I know you pay about $1 million a year, but what's the minimum to that each year?
The base for all of them, I think, is around 300.
Okay, so you have 300,000 that you need to contribute each year, but you have enough cash value to at least pay that
For a few years.
for a few years. And what you're saying is even worst case scenario, you have a couple of years of runway there, and then all the money that you make, because you're an entrepreneur, so it comes in clumps, you put anything that you're not living off of, you go to repayments.
Right. And then plus, because I've been doing it now for 5 years, a lot of the policies are starting to get pretty efficient.
Yep.
So I just funded one that was like 39 grand of premium and cash value grew by 66. So it's like, if I had to do that, if like my income went away, I could keep doing that. And essentially I still am getting more availability. And that's again, if I just stopped making any income.
Yep.
So that's kind of how I view policies. And I only use them for things like this, for liabilities. If I've just got a bunch extra where it's not going to hurt me from doing an opportunity that comes up.
I hear you.
Because I truly believe the best use for policies, first, pay debts off that you're paying high interest on.
Mhm.
If you can borrow at 5 and pay off 8, 9, 10, 15, 20, 25% credit cards, do that and then recapture the money. That's the best use. Once those are all gone, second best use, take the money at a control cost of, let's say, 5, 6%, go make a really good return. It's going to have risk, but that's how I've gotten that much in cash value. It's because I've been able to invest and save a lot of money.
Mhm.
Now I can go buy the liabilities and not be a dumb decision because
Yep.
I'm using all my liquidity.
Would you recommend people paying off their mortgage using life insurance?
No.
Okay.
Not a chance.
What's the difference between that and a car loan? It's just the difference in interest rate?
I would say the difference in the volume of interest over time, or not the volume of interest, that would make more sense if you're looking at the
Yeah.
mortgage. I would say it's more or less because of how long that loan can be for.
Such an attractive loan if you understand opportunity costs. Like
Right.
I get to 30 years short on the US dollar that's getting less than valuable. Like
That makes all the sense in the world because our mortgage is 2.875.
Yeah. Okay.
I used to think when I did mortgages, pay extra, pay extra, pay extra. You'll pay it off 11 years sooner if you make one extra payment a year. It's the dumbest thing ever because you're paying extra on a 2.875. You can easily take that money and go make more.
Mm-hmm.
And then you're paying off the future payments that are going to be a heck of a lot easier to make.
Yeah,
in
'cause of
30
the
years.
inflation.
Yeah, because of inflation, that payment gets easier and easier and easier to make.
So if you had $10 million of cash value, or if you were a billionaire, you would still keep that loan.
That's where the argument comes in. Like, it depends on how much cash value I have. I think it might make sense if I had 20 million cash value. And like, for instance, we owe, I
But
think
mathematically that wouldn't. If you're paying why would you want to pay 5% to pay off a 2.5%?
actually you're right. Never mind. I take that back. If my rate was like 7 or 8%.
Okay, fair.
Then that,
okay, that's fair. Okay. We're actually in agreement. We agree. If I had 20, 30, 40 million dollars of cash value sitting, I wanted to buy a car. It was a 7%. My control cost was 5%. I wasn't going to tie up all that money anyways. I would use my policy to buy the car versus done. Like I would. It just comes down to your comfort level. And I think you're in a place that a lot of people watching your content, maybe like they would be taking 40, 50, 60, 70% of their liquidity to buy something that they potentially could get a bank loan on. And that's where this discussion,
that wouldn't make as much sense.
it wouldn't make as much sense. And I want to give you flowers because I've been going at you in a very nice way, in a very Caleb Guilliams way.
Very Caleb Guilliams way.
The making content, helping people buy cars with infinite banking, what you do is you're inspiring people to save money that wouldn't already save. They're already going to buy that car. They're either going to pay cash or they're going to be in debt. You're encouraging them to start saving. You're giving them the carrot, which is you can drive the dream car and still be ahead, or like still be more ahead than what you would do option A kind of deal. Mm-hmm. And that's what I want to praise you on, because you're helping people, you're protecting people, you're insuring people, and you're helping people save more money that weren't going to save. And that's the hard nature when you include infinite banking. Is I'm looking at this from a very analytical, technical deal about this versus this, but we know that most people do not think that way. It's all emotional based. And so you're taking someone who's actually not saving anything. Now you're helping them save money into a life insurance policy. People would freak out like, oh, you should invest the difference. Guys, they're not going to invest the difference.
Right.
They're going to spend the difference. So they're saving money. Now you're helping them buy cars. I could be like, don't love that. But over the next 30, 40 years, they buy their dream cars. They have more money than what they would have. I'm not endorsing that strategy. I'm not saying that's the way to get rich. I'm just saying in that scenario, they may be better off because they're watching content like yours. They're clients of yours, and you're like helping them grasp that. And so I want to acknowledge that, where it's not all black and white from a standpoint. I'm talking to the person that actually wants to optimize, but in a lot of cases, people aren't in a situation where they have that luxury. They're trying to survive. Mm-hmm. And in a lot of cases, the infinite banking concept can help them save more. And that at the end of the day, saving more money is the secret sauce. Is if we can help people save more money over time, they're going to win. That's
the biggest thing. I'm teaching my daughter this right now. My daughter is going to be 18 next month, which is wild, freaking wild to me that I have a 18-year-old daughter. But when she started working, we got a joint account. So it's a custodial account. I'm on it. She's on it. I see when she gets paid her paychecks. I immediately, right off the top, go take 25%. Boom. It goes into a policy built for her. So now she is saving money inside of infinite banking, and then she uses it when she needs it. So her first car at 16, we bought from the policy because she needed a car. She was 16, right? There's a couple ways we can do it. That's what we've been talking about on this video. She can go get a bank loan, but I'm teaching her how to be her own bank. So we bought the car with the policy. Now when she makes a paycheck, she's paying the car loan back to her policy. So she's saved up from doing those two things, paying herself back for the car and me taking 25% off the top. She's saved almost $8,000.
It's amazing.
Me at 18, I didn't know how to save $8.
Yeah.
You know what I mean?
What's the average savings rate? And what I mean is not what people are earning on savings, but how much people are actually setting aside. What's the average in America?
Less than 5%.
Yeah, I'm going to prove your point. You're creating a system where she's saving 25%. Did I hear you correct? Saving 25% with the help of dad. The average is 4.6%.
Crazy.
So her life is going to be changed dramatically just by that for savings.
What I've started doing, this is not investment advice, guys,
Okay.
but what I've started doing, this is just simply what I do and what I'm helping my daughters do now, is I've started using these policies, these infinite banking policies, to purchase dividend-paying stocks. So we're talking about the stocks that have a track record like Pepsi, Coca-Cola, Johnson & Johnson, Procter & Gamble. They're considered dividend kings. They've paid a dividend every single year that's increased for 50 years at least. Pretty good track record, right? So I'm using the policy to buy those. And then just like inside of an infinite banking policy, we have the dividend option purchase PUAs, which rises the cash value, gives you more death benefit. So I'm using the policy to purchase the stocks, and then the dividend from the stock, I'm having that purchase more stock. So I've got an ever-increasing stock portfolio, which is an ever-increasing dividend. And then when I retire, I can just use that dividend as tax-free income.
How are you paying the interest on the life insurance?
I'm just letting it accumulate at the end of the year and paying it that way. So that's kind of like a loss in the scenario.
So you sell the stocks or you pay it out of pocket?
I just pay it out of pocket.
Okay.
But what I'm doing now is I set my daughters up with accounts through M1. I do mine through Robinhood, but they don't have a custodial account with them. So M1 has a custodial account. So now my two daughters, I'm just having them invest every single month. So the one that works, of that 25% I said that I'm saving for, half of it goes towards the policies, half goes into buying the
car,
the dividend paying stocks.
Oh, nice.
And then she's also paying herself back for the car. Yep. So she's saving $196 a month for the car, plus 25% of her income.
And when you say saving, she's paying back the loan.
Right. So it's going into her policy. She could use that again. So she's saving it.
Yeah.
It's paying back the policy loan. That's her policy. I don't touch it. It's just for her. And then the difference between the two, the 25%, that's going into policy and dividend paying stocks. Mm-hmm. So now I think she's got like almost $1,000 in stocks already.
Incredible. At
18. I did the math based on these stocks. This is just over the last
not investment advice.
Right. Just over the last 25 years, these stocks have averaged about a 15% growth annualized, right? So if I was being real conservative, I threw into the calculator, like if it just grew by 8% every single year until she's like 60, her stock portfolio is millions and millions of dollars by just putting in what she's putting in now. That's not if her income goes up, which it most likely will. She'll have, I think it was like $5.4 million. And then I didn't even do the calculation on how much the dividend would be at that point, but then that's just retirement income. 100% passive, all because of what I set up for. I wish my parents would have known some of this stuff and set me up like this, because I'm teaching my parents this stuff and they're in their 70s now. So it's nuts, man. The savings rate's insane.
The issue. The last thing I'll say is the buy term and invest the difference. Where we would disagree with this strategy is if you include the external benefits, and you're using your policy to do lots of things, buy cars, buy investments and all. I'm using my policy to buy businesses and, look at for investment opportunities. And over time, you compound this over 20, 30 years, time will tell, and it will really come down to, can our external benefits be greater than, can the internal and external benefits be greater than buying term and invest the difference? For some people, it won't be. For other people, it will be. And it's not just a rate of return for me. It's also like enjoying life. And I'm much more alive investing in people and things that I care about than potentially putting my money all in indexes. And I will be very clear. I own crypto and I own the S&P 500 index. I do. There's that. I think it's a very smart passive, as passive as it really comes. And so I'm not anti-investing in the market. I don't think the market's a great place to store money, though it is liquid and it could be a portion of storing money. But I do believe that life insurance is a better place to flow and save money. And then investing the money, that's the conversation. The cool thing is you're actually investing your money in the market. So you're not anti-stock market either. You're investing your money in the
I
stock
used to
market.
be. Yeah. I started learning about the strategy called buy, borrow, die.
Yep.
I'm sure you know that strategy.
Mm-hmm.
So for those of you that do not understand that strategy or have heard it before, you buy assets that appreciate in value. As they appreciate, you borrow against them. Borrowing is not taxable. You're not taxed on the appreciation. So then you take that borrowed money to go make more by buying more assets that appreciate. So over time, you get this huge amount of equity you're borrowing out of assets that's not taxable to either live off of his income or invest to make more. And then when you die, you get a step up in basis. So your family inherits all these assets at their new market value. They can sell them, pay off all of your debt that you had on them, keep the difference, 100% tax-free. It's incredible. So I've actually started buying the assets like the dividend paying stocks as a plan to eventually, they're going to go to my heirs with a step up in basis.
Death benefit and life insurance just makes it that much better because the death benefit's a cherry on top.
Yeah, it just adds on top of that. So one thing that I tell people all the time is infinite banking is not a silver bullet. It's not, you're not going to do that and all of a sudden become wealthy. It's not going to happen. You get a life insurance policy and think you're going to become rich and wealthy, you're insane. It's what you do with it that matters.
Great.
So if you get it and you use it really, really wisely and you always pay back policy loans and you always have a plan to deploy the money into something that's going to make a return, you'll do extremely well. And my argument would be you would do far better than buy term and invest the difference. Mm-hmm. That's just my argument on it, because the term will eventually run out and all that money gone forever. With infinite banking, the longer you live, your family's paid out even more because of the rising death benefit. So it's all about how you use the policy. I think you use it extremely well. I've done a decent job using it. And we try to teach all of our clients, like, put money in the policy, leave it there if you want. It's better than having it sit in the bank. Mm-hmm. But the best use is to use it and deploy it and make a spread on the money. If you can do that, you're going to be ahead.
Yeah. I love it. I know part 2, we're going to read some of the top comments of our past videos and see react to them.
That'll be fun. That'll be fun. Thank you for having me.